A friend calls you on a Sunday evening. He has a business idea. He needs $50,000. He has done the math, he says. Conservative projections show a 3 times return in 18 months. He has a deck. He has a prototype. He has conviction in his voice and the specific kind of silence after his pitch that means he is waiting for you to say yes. You do not say yes. You do not say no. You say, "Let me think about it." You hang up. You open the calculator on your phone. $50,000. You have $740,000 in liquid assets. The $50,000 is 6.7% of your liquid assets. If it goes to zero, your life changes by nothing. If it returns 3 times, you gain $100,000 for a phone call on a Sunday. You know your answer. You have known it since before he finished talking. But you did not always know how to answer this question. There was a version of you that would have said yes to anything. There was a version that would have said no to everything. Both of those versions lost money. This is the story of how you learn to tell the difference. You are 21. You work at a warehouse for $2,600 a month. After rent, food, gas, and a phone plan you share with your cousin, you have $900 in a checking account. A guy you know from high school, Victor, has an idea for reselling refurbished electronics. He needs $900 for inventory. He shows you a spreadsheet on his phone at a parking lot outside a gas station. The margins look real. You transfer $900 that night. Victor buys the inventory. He sells 3 units in the first week. Then the supplier sends a batch of defective screens. Returns pile up. Victor spends 2 months trying to fix the margin. He texts you updates every Sunday, short, honest, increasingly exhausted. By month 4, the storage unit costs more than the remaining inventory is worth. He calls you on a Wednesday night and says he is shutting it down. He offers to pay you back in installments. You tell him to forget it. He does not forget it. He will remember that $900 for a long time. You never see the money again. You do not feel the loss. Not because $900 is not money, because $900 is exactly what you had before you had anything, and returning to zero when you started at zero does not register as a wound. It registers as a Tuesday. The cost of this lesson is $900. What you learned will be worth $900,000 over the next 20 years. When someone fights to the end and still fails, the failure is data. When someone quits before the data arrives, there is nothing to learn. You are 24. You've been saving for 14 months. Your checking holds $6,200. It is the most money you have ever had. A coworker named Troy shows you his phone during lunch, a biotech stock. It tripled in 3 weeks. He bought it $14. It is at $41. His portfolio is up $4,300. He is grinning. You go home that night and deposit $3,000 into a brokerage account you open in 11 minutes. You buy the stock at $43. It drops to $38 the next day. You tell yourself it is a dip. It drops to $29 by Friday. Your $3,000 is now $2,023. You feel a sensation in your stomach that you have never felt before. It is not fear. It is the physical experience of watching money you worked 400 hours to earn evaporate while you refresh a screen. You sell at $24.60. Total loss, $1,410. Troy still holds. He tells you it will recover. It does not. It drops to $9 by December. Troy loses everything he gained and $2,000 more. He does not mention the stock again. You lost $1,410. Troy lost $6,300. The difference is not intelligence. You had a smaller margin for pain, so you exited earlier. Your weakness saved you $4,890. You learned two things. First, someone else's entry price is not your entry price. Troy bought at $14. You bought at $43. You were not in the same trade. You were in the same ticker. Second, the distance between hearing about an opportunity and having a thesis about it is the distance between gambling and investing. You were gambling. You are 27. Your salary is $61,000. You have $35,000 across savings and a small 401k. A laundromat 2 blocks from your apartment goes up for sale. The owner is 68 and retiring. Asking price, $95,000. You do not have $95,000. You have $35,000 and a landlord who needs quarters. You spend 6 months studying the deal. You drive past the location at different times of day, counting customers through the window. You pull the county records on utility costs. You talk to the owner's accountant. You learn the machines are 11 years old and 3 of them leak. You learn the net profit is $2,800 a month after everything. You do not buy the laundromat, but you spent 400 hours learning how to evaluate a small business, reading P&Ls, understanding seller discretionary earnings, estimating CapEx on aging equipment. This is the investment, not money, time, 6 months of evenings spent on a deal that never closed. 14 months later, a different deal appears. A vending route, 34 machines across 12 locations, owner relocating, price, $41,000. You know how to read the books now. You wire $41,000. Every dollar you have outside retirement. You take ownership on a Tuesday. You learn. Money risk has a cap. You can lose $41,000. Time risk has no cap. The 400 hours on the laundromat you never bought taught you how to buy the vending route you did. Every hour spent on something that fails is an hour that a successful deal eventually inherits. You are 30. The vending route nets $3,400 a month. Your salary is $74,000. You do both for 14 months. You wake at 5 a.m. to restock machines before work. Your performance review says, meets expectations. You used to exceed them. A second vending route comes available, 28 machines, $36,000. You do not have $36,000 in cash, but a local credit union offers you a small business loan at 8.9% for exactly that amount, secured against the existing route. You take it. You now own 62 machines, generating $6,100 a month. Your manager at work tells you there is a director track 2 years out. Your friend Leah, who works in consulting, tells you over coffee that most small businesses fail within 3 years. She quotes the statistic like a verdict. Your mother asks why you need 2 jobs. You put in your resignation on a Thursday. Your first year of full self-employment, $73,000 in net income from the roots, less than your salary plus benefits. You do not tell Leah. Your second year, $118,000. You still do not tell Leah. Not because you are hiding, because explaining an unconventional financial decision to people who followed the conventional path is a conversation without a shared vocabulary. You stopped translating. The risk of this level is not money. The risk is that if it had not worked out, every person who warned you would have been right, publicly, permanently, and without any obligation to understand the context. Reputation risk cannot be hedged. It cannot be diversified. You are either right and vindicated or wrong and defined by it. There is no middle outcome. You are 33. You find what you have been looking for, an entire laundromat, not the one from level 3, a different one. 3,200 square feet, 44 machines, profitable but poorly managed. The owner runs it remotely from another state, and it shows. Broken dryers sit unrepaired for months. The parking lot has not been restriped in years. Net profit, $7,200 a month. But you see $12,000 with new machines and proper management. Purchase price, $280,000. You have $145,000 in liquid capital. A bank would give you a loan, but they would require a personal guarantee. Your house, your savings, everything on the line. You do not take that deal. Instead, you negotiate seller financing directly with the owner. He is tired. He wants out. You offer $70,000 down and $210,000 financed over 5 years at 8.5% interest, secured by the business assets only. Non-recourse. If the laundromat fails, he takes it back. Your personal savings, your home, your retirement, untouched. He agrees. Most buyers do not know to ask for this structure. You learned it from reading 40 acquisition case studies during the 400 hours you spent on the laundromat you never bought. That is the structure. You did not invent it, but you found it because you studied longer than anyone expected you to. Month 3. A water main breaks, $14,000 in repairs. Insurance covers $6,000. Month 5, revenue drops 30% during parking lot reconstruction. Month 7, stabilization, new machines arrive. Revenue climbs to $13,800. By month 14, cash flow covers the seller payments with $4,200 monthly surplus. You hire a part-time manager. You learn, at this level, risk stops being personal. 3 people restructured their lives around your decision to buy this building. Your risk was measured in returns. Theirs was measured in rent payments. You had a floor beneath you. They were standing on yours. You are 37. You own the laundromat, 2 vending routes, and a portfolio of index funds you have been feeding for a decade. Your net worth crossed $1,100,000 last quarter. The businesses run without your daily involvement for roughly 80% of operations. You sit at the kitchen table across from your wife on a Saturday morning, and she asks a question she has never asked before. Can we stop? You open a spreadsheet. $1,100,000 at 7% generates $77,000 a year. That covers your lifestyle with a $9,000 margin. You could stop. Sell everything, park it in index funds, never risk again. Then you run the alternative. Use $220,000 in equity to acquire a commercial cleaning company with $31,000 a month in recurring contracts. If it works, combined cash flow reaches $38,000 a month within 2 years. In 10 years, the difference between stopping and continuing is $2,700,000. That is the price of safety. That is what the word enough costs when you say it too early. Your wife looks at the numbers. She says, and if it doesn't work? You say, we fall back to $800,000 and live 20 years instead of 25 before we need to think again. She is quiet for a long time. She says, do it. Not because she loves risk, because she did the math and understood that the most dangerous number on the spreadsheet was not the downside. It was the opportunity cost of standing still. You are 42. Your net worth is $2,600,000. The laundromat was sold 14 months ago. The cleaning company and vending routes generate $26,000 a month with a manager running each. You built it from machines, leases, seller notes, and 62 vending locations that dispense profit in quarters. Your phone rings twice on the same Thursday. The first call is Victor, the guy from the parking lot with the refurbished laptops. He started another business 4 years ago, commercial cleaning. He just signed a contract with a hospital network worth $1.2 million a year. He calls to tell you that your $900 was the first time anyone believed in him. You tell him to keep it. It was the cheapest education you ever bought. The second call is Leah, the friend from consulting who told you most businesses fail within 3 years. She's 42 now, same as you. Partner track, salary $210,000, net worth $680,000. She did everything right. She never lost a dollar. She never risked a dollar. She calls because she is thinking about leaving the firm. She's been thinking about it for 8 years. She asks how you did it, how you walked away from that director track at 30 with nothing but a vending route and a loan from a credit union. You are quiet for a moment. You do not say, "I was braver," because you were not braver. You were more afraid of staying than leaving. That is not the same thing. Leah will not leave the firm. She will think about it for another year. She will retire at 62 with $1,800,000 and a pension. She will be comfortable. She will never be free. Not because she lacked talent, because she never had a scar that taught her what risk actually costs. Victor risked with nothing and built something from the wreckage. Leah played it safe with everything and built a cage with excellent benefits. The gap between them is not intelligence. It is the accumulated weight of every decision where one chose the known and the other chose the calculated unknown. Your phone buzzes. A text from your friend, the one with the startup, the one who needs $50,000. You stare at the screen for 40 seconds. Your thumb hovers. You type 3 words and hit send. Send me the deck. Not because you believe in the startup, because you have $740,000, and losing $50,000 will not change your Wednesday. And the version of you that once lost $900 in a parking lot knows exactly what that $50,000 might become if the person holding it has the thing that no spreadsheet can measure: obsession, the kind that does not stop answering texts. The risk was never the money. The risk was always the version of yourself you would have been if you had never placed the bet.